Welcome everyone to a special Directed IRA webinar and Directed IRA podcast episode. I'm Mat Sorensen. I'm going to be joined today in this episode by Jamison Manwaring. He is co-founder, CEO of Neighborhood Ventures. They're a multifamily syndicator, do lots of big multifamily properties here in Arizona. And we've seen a lot of IRAs invest with him over the years, and he's really an expert on analyzing investments. He came from Wall Street, working at Goldman Sachs, and eventually transitioned into a real estate career. So I thought it'd be helpful for him to come on and talk about that, talk about looking at investments and analyzing that. We'll talk about real estate and stocks and that stuff. So we're going to be getting into that today. Now, before we get started, I just want to remind everyone, this is meant to be educational in nature, okay? This does not constitute an attorney-client relationship. This is not financial or investment advice. This is simply an educational webinar. Even though Jamison's here and he has funds and stuff that people invest in, trust me, this is not a solicitation for him. I don't know. Do your due diligence, research him. Frankly, I don't even know how the investments are doing. I just interact with Jamison. We know him and know he's an expert on what we want to talk about today. So do your own due diligence. And that's just, attorney Matt coming out here at the beginning. It's boring, Matt, but he can go away now. We'll get back to fun, Matt. So just a little bit about me. I am CEO at Directed IRA, Directed Trust Company. If you didn't know, we have over 10,000 accounts, $1 billion in assets invested in alternative assets like real estate, private companies, private funds, notes, crypto, all these cool things that people want to invest in. You can actually use an IRA, and that's what we're doing here every day at Directed IRA. Best company in terms of customer service in the industry. We have competitive fees. There's pretty much nowhere else you want to be. So you can learn more about us at directedira.com if you're still learning about us and self-directing. Now, I want to talk about Jamison's background here. We'll bring him on and cut him in. We had a little difficulty with the audio in the live broadcast, so I just want to give a little background about him. So Jamison basically started on Wall Street out of college. He was an equity analyst at Goldman Sachs, analyzing particularly the tech industry. And this was at a time, and tech stocks still are very volatile, of where tech stocks were going up and down. And Jamison's job was basically to say, buy, hold, or sell, right? And they would put ratings from Goldman Sachs on these stocks on whether to buy, hold, and sell. And obviously, in order to do that, they would take a ton of analysis into account in looking at those stocks and deciding, do we think people should buy this, hold it, or sell it? So he had gained an excellent perspective in terms of looking at stocks, looking at risk and reward and those types of factors. Now, one of the things he learned, and as he explains his story, is, tech stocks had a lot of volatility. What he ended up doing with money he was making in Wall Street was he started buying real estate for himself. And everyone he was working with was like, Jamison, what are you doing? You're buying real estate? And it was interesting from his experience that a lot of people on Wall Street barely knew about buying real estate like yourself. Like they might know about buying a publicly traded real estate company, but like how do you actually do it yourself and buy an investment property and get tenants and all those things, whether it's retail or commercial or multifamily or single family, whatever it is. And so what Jamison realized is he really liked real estate as an investment asset. And one of the key things, what we started off our conversation with was really there are three factors to consider when investing. And there are three factors in kind of your quote unquote investment analysis to look at. The first is risk. Obviously, some investments have more risk than others. For example, crypto would be on the high risk side, right? You could buy some crypto coin that could go way high and has a huge reward, but it could also go to zero. On the other hand, you could have a less risky asset like a very established Fortune 500 company that's been around for years, that has products people buy every day, less risky. Or you could have an actual hard asset like real estate that's physical, that's not going anywhere, that you could rent out and someone will pay you rent on, or that you could sell, someone for a gain at some point. So each of those different assets has a different risk profile to it and different rewards that can come from it. A startup company, we have lots of clients who invest in startups with their IRAs. Now, a startup company, if you think about it, that has a huge reward, right? Everyone's hoping to buy, Amazon before it was a big company, or Uber or whatever it is, at $1 a share, and then all of a sudden it's publicly traded and it's $1,000 a share, right? They want that 1,000x return. Okay, that does happen in the startup world. But you know what else happens in the startup world? Companies go to zero and you get nothing. And so there's a risk and reward that you have to analyze there when looking at your assets. And so we'll talk about that. And I think kind of one of the things Jamison, now doing multifamily real estate primarily, one of the things he likes about it, and the key is going to be his conversation about cash flow, frankly. So that's what we're going to get into there. And that's really the second part to analyze here. So we've got risk is the first, cash flow is the second. Now, cash flow can happen in a number of ways. If you're buying stock, and what most people might know from the stock market is you get a dividend. Now, some stocks produce dividends and they will pay out. Other stocks, like high growth companies, like a tech stock, for example, typically does not pay a dividend. Even Apple pays a very, very low dividend relative to its share price. And so now some stocks that have been around for a long time, or companies that try to attract investors, will pay a high dividend because they're looking for people who want to own that stock for the dividend it pays, not necessarily the appreciation of the stock going up in value. So you want to look at the dividend yield on stocks to learn about what's the cash flow I'm making. Now, the third component from investment analysis to look at is going to be resale value. Now, when we look back at cash flow, I was mentioning dividend, of course, with stock. And for real estate, it's pretty cut and dry, right? What's the cash flow on rental income, right? I don't care if it's commercial or multifamily or single family. I've got rents, I've got my expenses. What's my cash flow I'm making? What's the spread of profit I'm making every month in terms of my rental cash flow? But eventually, on the real estate or stock, we are looking at resale value. Is this thing going to go up over time in value? Whether it's real estate going up in value or it's stock going up in value. And now with all different asset classes, and this could be anything, think of a promissory note, right? Well, the promissory note has cash flow because it has an interest rate on it. If I loan someone money at 8%, well, I'm getting 8% cash flow. But I might also be able to sell that note, right? I could also sell that note to someone else who's willing to pay for it right now and buy me out of it because they want the stream of cash flow in the future. Similar how a bond may work if you're buying bonds. So resale value and what I can sell this asset for in the future is the third component. And a lot of people will focus on resale value in particular because that's where you can have a huge upside. Now, resale value is more speculative. Cash flow is more certain. On real estate, you can calculate it better. Now, it's not guaranteed. Even on a stock that pays dividends, you can look at that over time and say, what is the dividend they typically pay? And you can kind of average it out to know, like, what can I reasonably expect based on what they've done over the last 5 years, 3 years, whatever time period you want to look at. Resale value on stock and in real estate is much more speculative. So when you're banking on resale value, that's going to increase your risk as well. Now, there's some other factors to consider there, some tax benefits and everything like that. And of course, we love buying assets in our IRA here, and of course, the Roth IRA in particular, because it comes out totally tax-free on the way out. As I'm buying assets and I get that resale value and that asset appreciates, I don't got to worry about paying Uncle Sam. That gets to grow and build up on my retirement account. And then the Roth accounts come out tax-free. And of course, in the traditional accounts comes out tax-deferred. So we're going to cut in here to my conversation with Jamison, though, where we started focusing on cash flow and why he likes real estate and in particular multifamily. All the buzz, has been real estate is a hedge against inflation. I mean, I'm pushing that buzz too. I get it. I'm a true believer on that. But everybody, make your own decisions, of course. But multifamily seems to be even better because rent prices go up, rent rates go up like that. Leases renew and rents go up. And if cost of home ownership's gone up, interest rates are going up. Well, that means rents can go up. I mean, those two markets compete.
Yeah, and rents are up about 20% in a year. So inflation's up.
So your assets that you bought like 2 years ago, 3 years, you're probably your leases are renewing. You're probably like, inflation ain't so bad. I don't know.
It's a good hedge. Inflation has some other negative impacts, including, Fed coming in and raising interest rates,
right,
which can affect your debt and the resale value of a property. But it's a great hedge, especially when we're looking at generating cash flow. We're seeing in the last year, rents are up on average in the nationwide 20%, which outpaces inflation, right? Because inflation's up about 9%. So there are so many things that we love about multifamily. On the other side, our retail project, they're in 10-year leases, and they have increases in those lease payments over time, but they're preset increases. So, with rent for your home, every 6 months or a year, somebody is moving out. The rates tend to go up, and as an investor, you can move them up. So I really love multifamily in an inflationary market.
Yeah. Okay. Cool. Let's hit a couple. Let's go to some of these slides. I want to look at some of the common definitions on looking at an investment asset and trying to make sense of it. And so I just grabbed some of these. I'm going to just give these quick examples. So there's something called rate of return, and one common way is just your annual rate of return. So rate of return could be used in any time period, but let's just say it's in 1 year. So I just have a stock example there. You buy 100,000 of Apple stock, you get 2,000 in dividends, right? The stock's paying you a little bit of dividend. It goes up to 108,000, so you have an 8,000 increase in the value. But over that year, you really had $10,000 of increased value between the dividend and the appreciation. So you multiply that by you divide that by the original cost, and you come out with what the percent is, which for your rate of return, which in this example is 10%. And so you're basically taking what's my value increase, dividing it by your initial purchase of the asset, and you multiply it by 100 to get this 10% ratio. If you look at real estate, it works in the same way. And again, I just kept this as an annual example here, but if you're getting $200,000, you buy a property for $200,000. Now, one of the things about real estate is that might have been an $800,000 property, right? I'm just saying this is your cash invested on the real estate. So you had that $200,000 invested, and then let's say you had $10,000 in cash flow. This is after expenses, so you got to have real numbers here. Obviously, there's money going out, so this is after expenses. And the property goes up in value. So again, we're going back into taking into account appreciation of value and any cash flow off the asset in stock and in real estate. So the same example here, you have a 10% rate of return.
Yeah, and with stocks, most stocks certainly tech stocks that are growing do not pay dividends.
Yeah.
I think Apple does pay a small dividend. You can buy some more.
Is that a bad example, Jamison?
No.
I did actually look up Apple, and they did pay it. It wasn't that much though.
And they actually have so much cash that they have to start paying dividends. They don't.
I don't know why. Look, they retain so much cash. What are they doing with it?
And for a company like them that's so innovative, they want to try to invest internally, but they just have too much to deal with. But most growing companies are just going to be reinvesting capital in the business. They don't want to send it out to shareholders. So a lot of stocks I covered, in fact, none of the stocks I covered paid a dividend.
Yeah.
And it's all capital appreciation, which is another way for saying the only way you make money is when you sell the stock.
Yeah.
So if you have a long-term hold on a stock, at the end of the day, to ever make money on it, you have to probably sell the stock, which is kind of a bummer because I like that stock. I like that company. Real estate's great because you can really like a piece of property and it's going to generate cash flow for you, 5%, 6%, 7%, sometimes higher than that, sometimes less than that, depending on how you operate it and all the details. But you don't have to sell it to generate income.
Yeah.
And it's generating more value for you as time goes on. It appreciates. You pay down the loan, etc.
Right.
So I think that's why real estate was so appealing to me personally.
Yeah.
Because it had both of those aspects.
Yeah.
But I think that's important, and the way I look at it with just real simply is you got cash flow, then you have appreciation, and that. Both of those equal your total return that you're going to get on that asset.
And you mentioned something earlier about the loan and paying down the loan. So when I'm giving that example of cash flow, those expenses, what I might be considering an expense, might actually be paying down principal.
Sure.
If you, depending on how you're running your numbers, if you're considering pay down of principal as an expense, that's actually benefiting you. So I would have another increase of value of debt pay down that's helping me get a greater rate of return because now I owe less, so now I have more equity and value in the property if I were to sell it.
Yeah, and from commercial real estate, we tend to do interest-only loans.
Okay.
And so that isn't as much of an impact. But a lot of folks who own your own property, you tend to just kind of calculate that as an expense, but at the same time, you're paying that loan down.
Yeah.
And, sometimes pretty significantly if you own a property for 10 or 15 years.
Okay. All right. And there's some tax benefits there too. I don't know, of course, you guys know here with retirement accounts and even Main Street Business podcast that we do and all the real estate we talk about, there's a lot of tax benefits to owning real estate, but I don't want to get too far into this. I just want to look at this from an asset standpoint.
Yeah, a lot of details there to dig into, but I think you've covered it.
Yeah. Okay, so we've got the other thing to look at is another factor is return on investment. Guys, this is like the exact same thing. The difference with return on investment is this, you're basically doing the same thing. What is my return and what was my cost to purchase it? And you're getting a number at the end of the day on that value. So if I run some numbers here, and you can just look at the examples there on the stock and real estate example. That's going to show you my ROI or return on investment. And again, on real estate, I'm only looking at the cash invested. So here in the example, just on the real estate, I bought a rental for $200K. It gave me $40,000 in cash flow after expenses. And let's say this is a 5-year period. Okay, I'm not talking about this is an annual return period. This is 5 years. Let's say the property went up $80,000 in value. That's a $120,000 increase. That's my return divided by the original cost, $200,000. That's a 60% return on investment.
You know what I love about this is division, little addition, some multiplication. This isn't complicated.
Right. You don't need a calculator. I mean,
yeah, well,
you could.
Yeah.
I mean, I did the easy numbers there. But
the first time you look at it, it's a little bit of like a head scratcher, but managing investments does not have to be complicated. So I love how you put this together. It's easy.
Okay, we can share those now. So I think that remember at the end of the day, I mean, you want to have the highest rate of return or highest return on investment. So as Jamison was talking, back in the analyst days, it's sell. So why would you sell something? Like why would you recommend to sell something even back in that days or even now for yourself with your own real estate portfolio?
Yeah, and real estate's a little bit of a different animal than stocks. Stocks tend to be more volatile. There's more up and down, as we've seen this year.
Probably easier to get out of and into.
That does feed into some of the up and down. Some of the volatility is there's some herd mentality, and people start seeing a stock that has some negative news, and they can sell, and now the value's gone down. One word we use is a catalyst. So catalyst is what could either drive value of an asset up or down. So just think, an obvious one was COVID.
Yeah.
And the shutdown, when everything got shut down for 3 months. That was a catalyst, positive catalyst for many stocks.
Yeah.
For many real estate assets.
Yeah.
And it was a negative catalyst for others. And so as you look at and try to predict, what's going to happen in your portfolio. Right now, we know some things are likely going to happen over the next, year to 18 months. What catalyst could either drive our asset values up or down? Mm-hmm. And so one example with real estate is when that happened, when COVID happened, retail real estate, it was a negative catalyst because we were concerned the restaurants were all going to shut down. If there wasn't government intervention, they can't pay their leases. They're going to have to close. What ended up actually happening was restaurants did all right through the 2 or 3 months that it was closed, and then they boomed after because they had now created drive-throughs. They created delivery,
and
and they did it. There was a huge shortage of workers. But restaurants actually did okay. And they got through it, and now retail, it's booming. Especially if you have a drive-through. Now that trend has stayed, and then on the other side of it, office. We didn't know exactly what would happen with office, and now it looks like office is going to be down about 10 to 15% in the demand of office going forward. It's kind of how it's settling out because now more people are comfortable working from home.
Yeah.
And then the last example there is multifamily. We didn't know what would happen, but people stayed in the home, in their properties, and they paid their mortgage or their rent first before anything else. The collections were almost as high as before it happened.
Yeah.
And then shortly after, we saw what happened with real estate as people decided, I want to actually live in a place that I enjoy.
Yeah.
I don't want to live, in some of these states where there's a lot of restrictions. That's an easy example of a potential catalyst that can drive a stock up or down. And so it's not just looking at where an asset is, but it's looking a little bit ahead and having a prediction on what's going to happen and could drive it up or down.
Yeah. Now, I think in the stock market, this has always been something where I feel like I'm at an unfair advantage because I could look at that and I could be like, okay, I believe some of these trends, and I'm gonna put my money where my mouth is and invest in this trend, and I'm gonna, COVID hits, let's say I think healthcare stocks are gonna go up. Right. Because all the healthcare companies are getting all these demand for services, and people are going to be in the doctor's office more because they got COVID or other complications from it. So that's going to be a driving catalyst, and so I go invest in that. But the thing with the stock market for me sometimes, this is why I love self-directing, is there's a million other people already doing that, and there's a bunch of money with people with billions of dollars already doing that the same day. They can do it with a click of a button, and it's kind of been, I don't know, commoditized might not be the right word, but it's harder to have a competitive advantage and to know because it's already got priced up. I feel like people see those catalysts that are clear. Well, that's already way priced. That's already a high price.
It happens all the time, so they call it's already priced in.
Okay.
Right. So a company has great earnings results.
Yeah.
And you're thinking, okay, the stock's going to pop tomorrow, and it's down because it was already priced in the stock.
Yeah. Okay.
And you and me and average people that have our day-to-day lives, we can't stay ahead of all of that. That's why there's a whole industry of professionals who are doing that. And so if you're going to beat them, if you're going to win in the stock market, you kind of have to be ahead of them, and it is really difficult.
Or have a counterintuitive read on it that's kind of counter to what the trend is that most people presume is going to happen, but you feel strongly differently and you kind of beat them, I guess.
Yeah, and I think that's a great way to win, and if you're correct, you will win.
Right. And if you're out there all on your own,
so
like those that bought GameStop stock or something, I don't know.
having done it and kind of seeing how the sausage is made, I started investing in commercial real estate with the little money that I was being able to put away. I was not interested in putting it in the stocks that I was covering, or stocks that I understood well, even though I was right in it.
Yeah.
Because it didn't match my temperament. Mm-hmm. I like steady. I don't want to lose my money. I want to preserve my money, and I want to see it continue to grow. And it just didn't match that those stocks and that strategy. So I began as an analyst. It was funny telling my team, hey, I just bought a commercial building, 12-unit building. And they're like, why would you do that? And they knew nothing about real estate because they were stock people. And I said, well, my dad's a real estate guy. I've always been interested in real estate. And they were kind of like, now tell me about that. How's that work? And that's what got me to where I am today. I am much more suited for an asset that continues to grind it out versus trying to get ahead of the market and beat the market.
Okay. All right. Let's move over to real estate and some of the stuff you're up to now. So neighborhood ventures, you had already been buying some real estate on your own, right? I know you have some other stuff, but probably in real estate, but then now you have neighborhood ventures. Explain to me why you guys started that, and the type of properties you're doing, and then we can kind of get into some of your slides too on it. Yeah.
So I came out to Phoenix to join LifeLock, running their investor relations. They were a company I worked on their IPO, stayed involved with them, covered them as an analyst, wrote research on them. So I got to know the CEO and
Did
CFO
you recommend
quite well.
to buy them?
I was a big buyer.
They wouldn't have hired you eventually.
So, yeah, exactly.
We're not hiring an analyst as like a sell.
No, that's very true. There is a conflict of interest there. They were always misunderstood by analysts, in our opinion, by professionals, because they kind of saw it as a little bit of a Wild West company, and in some ways it was. But we still thought the fundamentals were good, and that proved out. But joined them. I joined them about $8 a share, and we ended up selling a year and a half later for $24 a share.
Okay.
I wanted to stay with them for a long time, but someone came in and bought us. It was actually a big cybersecurity company out of California, came in and bought us and folded us in. And I had done that side real estate deal, and I wanted to do more of that. And I decided to do another project similar to that. And then, at some point with real estate, it is a cash intensive business. So anyone who owns, one property, who's doing it direct, that, you can save up a couple $100,000 and it's into one property. So, we began looking at new creative ways to try to raise capital, to pool capital, so that we could go and scale up a business and buy more multifamily assets. And crowdfunding was something that was new. There were new laws passed that allowed it. And I met my now co-founder, who had a lot of real estate expertise and really loved the idea of taking crowdfunding to a new audience of investors. Just to kind of back up a little bit, prior to crowdfunding laws, you had to be a wealthy accredited investor to participate in partnerships of investing in apartment buildings. And
you had like $1 million net worth, 250,000 annual income, or 200, 300,000 if married or single. So,
and typically like 50,000 minimum investment.
Right. Yeah.
And that was kind of what the industry has done for years. So it was a very small group of people who could participate in that. And so we launched Neighborhood Ventures with the idea to allow anyone to invest in real estate with $1,000 investment. And so fast forward 5 years, we have 5,000 investors on our platform now. They're all in Arizona. And we've recently launched some projects nationwide to begin to grow outside of Arizona. But we've bought apartment buildings that were in good locations, but they were underperforming. And so we go in and have a plan to renovate the properties, maybe add a washer and dryer, maybe add certain amenities. And some of these properties haven't been renovated for 40 years, owned by the same person. So we buy them, go in, put a big capital infusion in, but we have confidence that we're going to get the rents after those properties are renovated, and it's gone really well so far.
Okay. All right. So let's go to some of your slides here. I'm going to try and get to your stuff. So, because we're...
Mine's not as complicated as yours.
So I don't know if you want to drive here, and then if you want to kind of go through your stuff, I'm going to be grabbing some questions. So if you're throwing questions in the chat or Q&A, I know some of the team might be answering some of your questions on accounts, but if you have questions for Jamison or me, throw them into Joanna's going to try and grab them and message them to me here. So.
Yeah, I think the first thing is, real estate is in a really volatile state right now, depending on where you're at. And I guess maybe the better word is uncertain state. We know what's happening kind of at the level of buying a home. We saw a huge run up in values, huge run up in demand, very little supply. And let's talk about how that now impacts owning an apartment building, multifamily investment with that backdrop. So the first thing is rents are up, as we already alluded to, 17% nationally. In Arizona, they're up about 22%. So some of these other, Miami and Florida, Texas, there are some markets the rents are even higher. That's a lot to do with continued migration out of some of the higher cost coastal areas. And then those areas were already growing before, just like Phoenix was, so that continues. The big thing that's happened now is the affordability gap, which is defined by the difference between renting and owning. So if I can rent a property at X and I can purchase a property at Y, the difference is the affordability gap. In 2019, before the pandemic, that was about $280 nationwide. So it cost you another $300 to own per month. But you get tax benefits, you get pride of ownership, those other things. That was a trade-off.
It
can go up in value.
Yeah.
2020, the end of the pandemic year, or the big pandemic year, it had increased by about $100. Where we're sitting now is pretty astounding. It's $1,000.
Wow.
From cost you $1,000 more now to own than rent. Rents have moved up, but buying a home has gone up even more. And now with current interest rates, it's $1,000.
Because you for home ownership, you have the double whammy. You have massive price appreciation, and now you have high interest rates. Yeah. It's like that's the two things that are going to make it like unaffordable.
Yeah. And so from an investor standpoint, owning multifamily, there's a lot of room here for rents to continue to move, right? That affordability gap will hit an equilibrium at some point, but there is a shortage of housing. We know that. Mm-hmm. One of the things that's happening this year, there's more multifamily units coming on the market than any time since the 1970s. There's been a glut of supply that's been sitting there, hasn't been able to get through the system, whether that's delays at the city, delays with construction, delays with materials. This year, 420,000 new units should be added nationwide, about 20,000 in Phoenix. But there's still a shortage, and it's going to take a few years for that to work itself out. In Phoenix, based on what is expected to be coming for apartment units, we're still 20,000 short by 2025. So it's all supply and demand. Real estate is so much supply and demand that there's a shortage of units, and that's going to continue to drive rents, can continue to drive the desire to own multifamily assets also. And then the big uncertainty is with interest rates. What's going to happen with inflation, and how will that impact interest rates? It does increase your borrowing costs when you either buy a home or buy an apartment building. And when you go to sell that building, that also can have an impact because that new buyer is going to have to pay a higher percent. But at the same time, rents, and I lost that slide on that last one. Yeah. Rents and occupancy are really strong. And then our fundamentals behind multifamily are wages. What's happening with wages? What's happening with employment? That's our customer. When you own multifamily, your person who's paying you is that consumer. Yeah. And those fundamentals are still really strong. So a lot of things are happening, but multifamily, I think, is positioned well and we're in our the word you used before about having a view that may be different than everyone else. Mm-hmm. We're buying core assets in core locations, central locations, that we think are going to continue to have desirability. We're not buying assets in smaller tertiary markets. We like a Phoenix. We like downtown, close to light rail, close to mass transit. Yeah, those are the assets that we like right now.
Okay, all right. I got some questions coming in here. Let's see. Let's see here. This is from Joanne from California. I'm going to read part 2 of her question first. I'm nearing retirement. If I purchase a rental property, would it make more sense to purchase it outright, or do I really want to carry a mortgage? What would you say? What's your opinion? It's talking about an investment, but it's a rental property.
Yeah. If you're nearing retirement and you like that property, I don't think there's anything wrong with paying cash and getting a 5% cash return on it and sleeping well and not having to deal with a mortgage.
Would you do that though, Jamison?
Not at my stage in my life because I still have a couple decades of earnings. But if you're nearing retirement, maybe your calculus is a little different. What we do for our properties, we like to have under 55% debt.
Yeah.
So that's very conservative in the industry.
Yeah.
A lot of folks will try to lever up to 75, 80, 85. Might not be a bad idea to put a 50% debt. Still is very considered conservative, I would say, from an investment standpoint. And then you can maybe put some money elsewhere. But I'm a conservative guy.
Yeah, you are.
We're cautious operators. We have one property right now that has very low debt on it. We like that. It feels nice.
Yeah. I mean, I get it. I've had some clients over the years. I remember one that does kind of these no debt deals, and they raise money that way. And they're like, no debt. We don't use any debt. And they're like, well, we can pay the bank 5% or we could keep it. And they're like, we just decided to keep it. It takes more capital to do that, obviously, or to even do it at just 50%, But especially when rates are going higher, you're actually keeping that.
Yeah.
Would it otherwise be a 5% expense that's coming off your investment? But Joanne, I think that's a good question. I mean, what I would say is I would kind of look at, this is the non-expert now talking. So for whatever this is worth, Joanne, is I would get some debt on it. Look at what the rates are. They're not, even if it's 5%, 5.5%, what you can get on a rental property loan. You're not going to get more than 80% of a mortgage anyways, typically on a single family rental. So, but then pay attention to the cash flow. Be reasonable about the expenses. Take into account a vacancy factor. This might not be rented for 10% of the time. So that if you think you get $1,000 a month and $12,000 in rent, well, maybe you got to take 10% off of that just because there might be times when someone's not there. So, and then I would consider your other assets, Joanne. Like, if you have other assets that are liquid, that would help you through retirement, let's say we go into a recession and you're worried about that property not renting, for example, and having a mortgage, then I could see, if you have other assets that you might feel more comfortable, like you could kind of bail yourself out or weather the storm, so to speak. Or you just, don't do the debt. Like James said, you're in retirement. Be conservative. Okay, this is from Robelin. I almost want to say Rebellion, but Robelin, sorry. I'm getting these cut and pasted from me here to my phone. So, but Joanna's doing this a good job. She says, I've been thinking about owning rental property in other states. I've been advised to stick with the rental property in my area state. I live in California. It doesn't make sense to purchase here. What are your thoughts about finding good rentals in other states? What do you think? Have you bought anything in California?
I haven't bought anything in California. Rentals, if you've never owned a rental, they're a ton of work.
Yeah.
You can't neglect them. They're like a child. So you love them, but they're a lot of work. And I wouldn't have a child halfway across the country myself because
it's like
I don't want to be a bad
boarding
parent.
School.
Right? So if you're going to do that, you have to hire a property manager, which changes your whole expense profile. A lot of times a property manager doesn't want to manage just one unit. There are other options for you to invest in real estate, like invest in a fund, invest in a partnership like what we do, where you don't have to be the landlord. Landlording is a lot of work. I don't want to do it. We have a team that does it, and they're really good at it. It is a lot of work. When you have to evict someone, which you will, that is emotional. It is hard.
Yeah.
So, you got to know what you want to do. And if you're going to do that, I would prefer to own in my backyard and have done that. And that's much more manageable.
Yeah. It's interesting. I've gone through different phases of this myself as I've owned rentals here in Arizona where I live, and I can go over and the sink's leaking or there's an issue. And on the one hand, I'm like, this is nice. I can take care of it. But after a while, I was like, this is not nice that I can take care of it. What am I doing here? I'm on YouTube, like trying to figure out how to fix a leaking sink, like I'm the last guy you want there. So, but I was like, I got caught in this, I can self-manage it, And eventually I realized, frankly, that my time wasn't worth it and that I'd be better off having professionals that could manage it. And having it, frankly, a property manager, even though it was in my own backyard. Yeah. And then, of course, if it's a property, I have properties out of state too, that I went to because I felt like I could get a better yield, a better return, which they've actually done well. But like I definitely have a property manager there because, and that's where you got to be careful. I say when we're talking about the risks earlier, the out-of-state rental has a lot more risks. It might have more return because it might be in a market that has a better rent, ratio to purchasing power or what you can buy. But it definitely has more risks. And I've realized this in some of my out-of-state rentals is I don't know the area as much. It might be in this little town that sounds like a good, town, but I didn't know it was actually the crappy part of that town because I'm not there. And so there's just little factors you just don't know. And so that does tend to carry more risk. And we have seen more clients that have had bad real estate deals. They've been in cities they don't live in and they've never been to.
Yeah, and you may even go for a weekend and drive around that neighborhood, spend a weekend there to get a feel for it. But then when things change in 2 or 3 years and you're living in California and it's somewhere else, you're not involved in that like it is in your backyard. When things change in the area that you live in, you tend to know that and you can react to it. So it's something that, I think that's a good point, man. It's a little bit more risky.
Okay. Ooh, the questions are flying in now. Jeez. Okay. We shouldn't have started doing questions. All right. Let me take one more, then I'm going to let Jamison hit some of maybe a property or two you're working on now or some of actually, whatever else you want to cover. We probably do 2 other points here. I'll let you find your slide. I'm going to go hit a question here. Okay. I'll ask you this in your deals, Jamison. This is from Sid. Ask, how do you pass on depreciation? They said bonus depreciation or cost segregation benefit to your investors in multifamily.
Yeah.
How does that work?
Depreciation is one of the big advantages to owning real estate. And when you own equity like you do in a partnership with what we do, you get that pass through to you. So it's a beautiful thing. A lot of your distributions that you're getting for the year are typically offset by what you're depreciating. And it's a great, it doesn't necessarily matter if it's in an IRA because you get that benefit anyway.
Right.
But it's a big advantage with real estate.
Yeah. Okay, let's see. This is an anonymous attendee asked, isn't it much better, less risk, to invest in a multi-apartment complex, 100-plus apartments, as a limited partnership, rather than much higher risk and associated costs of an investment in a 2, 3, 4, 5, or 6-family house? A bad tenant is negligible in a 100-plus apartment complex.
That's exactly.
Yeah.
I absolutely agree with that. We own one building that's 20 units, and when somebody moves out, our occupancy is down to 95%.
Yeah. And
occupancy across Phoenix, across multifamily, is 95%. And so if you get 2 people move out, now you're already down to 90% occupied, and that's a 20-unit building.
Yeah.
So, it's a much you get diversification when you can invest in a larger apartment building with a pool of investors.
Yeah.
And you also have some managers, some experts who are on the ground doing the work. You can have a mix of doing some yourself, and that's what I tend to find a lot of people do. They'll do some themselves, and then they'll put some in with a fund and a limited partnership.
Yeah, and I think it kind of smooths out the bumps when you have more tenants, let's say a multifamily apartment building, because, tenants come and go and they leave, and, that's all just being averaged out over time. You're not really noticing it in your cash flow and expenses. But if it's a single family rental and that tenant's gone, nobody's paying rent for a month or 2, or maybe 3 until you get it re-rented if they trash the place. Yeah,
you're paying it.
That's true, you are. So that's 100% unoccupied. Yeah. Now, on the other hand, when you have someone there, it's 100% occupied. And I've just seen that as I was analyzing one of my properties that I'm actually listing to sell right now. Is I kind of went through how many months did I actually have this, because I had 3 different tenants in it over 5 years, and I think I had about 8 months. It would really surprise me of how it was not rented. Yeah. And so, but anyways, that's a great question. I think for those of you that are doing single family properties too, or even duplexes, fourplexes, stuff like that. obviously a tenant being out, you'll feel it more in the short term.
We're not buying any buildings less than 20 units because of that. And there's certain levels of scale. You know, once you get to 40 or 50 units, you can have an on-site property manager, which really makes your operations better. This is a good example of a project that we've done. This is our 14th project, and we just opened this to investors nationally. Okay. We've already raised almost $2 million from 225 investors in Arizona. Mm-hmm. In Arizona, we use the Arizona intrastate crowdfunding law, so it's a little different. So this is on what's called a Reg CF portal called smallchange.co. Yeah. And we just launched it a few days ago. That's open to investors nationally. It's $1,000 minimum investment. I can't actually talk about all the details of the project. You have to see it on the website. But if you go to smallchange.co, you can see it. You'll see the project there and all the terms and everything there. But this is a good example of a partnership project. So there's going to be some cash flow. There's going to be a good double-digit return to our investors. And this is right here, core Central Phoenix. This is about a mile away from your office.
Okay. All right, cool. So what do you typically do as your hold time? Like, how long are you holding these? Does it depend on the market? What's the properties you've already bought and sold? How long did you hold them for?
2 to 3 years.
Oh, really? So that fast? Okay.
Yeah. So when we renovate a building, it tends to take a year.
So your clock example, which I love, by the way, at the beginning. Yeah. I mean, you're maybe buying it, I don't know. I know you're not buying at 6, but maybe you're buying at 7. But that clock's moving fast. Yeah. Really, I think for someone, that 2 to 3 years. Is that because you add that value and that you kind of hit that number of where you recognize increased rents and everything?
Yeah, so you can do kind of a light touch reposition of the asset. Yeah. We go in and we do the full-blown thing. Okay. So this property, for example, the average rents are $975, and when we're done, based on the comps in the area, it'll be about $1,800 per unit. Wow. So we're doubling rent, and we're doing that because the rents in the neighborhood are already high. This building has just been neglected for a long time. So you're talking new flooring, you're talking washer and dryers, $30,000 to $40,000 investment per unit. Okay. So it takes about a year to do the work, to reposition it, to get it leased up to new residents. Then you have a couple of years of cash flow. Mm-hmm. And then once we have it operating at that level, that's when we sell it because we've done so much lifting, heavy lifting, that we've taken the value from here to here. And we could continue to hold it for beyond that, but the value increase is just incremental after that. Okay.
All right. I'm going to see if I don't know if you had any other slides you wanted to share. I know we're getting close.
The last thing.
And I'm going to grab a final question and we'll give our kind of final thoughts here.
We do have individual projects that folks invest in. We also have some bigger investors who said, hey, I have $200,000 in the stock market and I want to invest that all right now. Yeah. And, our projects, we're raising, $3 million, $2 million. So they don't want to put, $500,000 into that fundraise. Yeah. So we launched a fund 2 years ago. It's we're going to complete fundraising at the end of this year. We have about 40 of our biggest investors are in the fund, and the fund invests in all of our projects. Oh, okay. This is only open if you're an accredited investor, so you have to have $1 million net worth, not including your home, or $200,000 income if you're in a single, $300,000 if you're married. Yeah. But the great thing is it's a diversified fund. It invests in all of our projects from last year and this year. We're paying right now a cash distribution. We expected it to be 4% this year, but we've already increased it to 5% because rents are doing so well on these projects. Okay. The fund already has invested in 7 projects that are existing that are doing well. We expect over the next 2013, 2014 to start liquidating these assets, so you'll get paid back. And everything would be completed by the end of 2025, sorry. Okay. And so this is what's called a closed-end fund, meaning you'll get all your returns, your initial capital back by the end of 2025 at the latest, if not before then. Okay. And so this has been really popular for some of our investors who want to deploy a little bit more capital.
Okay. And then I know we've had a lot of IRAs at Directed IRA Invest and Neighborhood Ventures, and that's actually, we found them, and so it's just that IRA community and investing. So, but of course, do your own due diligence. It's not an endorsement really. We just want Jamison's expertise and want to talk about what they're up to too. So he's got the Kiss My Asset podcast. Your website is neighborhood.ventures.
Yeah.
Right? Okay, so it's neighborhood.ventures. If you just Google Neighborhood Ventures, you can find it.
We're the only ones, yeah.
That's how I do it.
Yeah, exactly. And we do some cool YouTube stuff. When our properties are in renovation, we go in and do an update and show you some of the before and after. Our investors love that because you can kind of see where your money's going and you can see the progress. It's not. I freaking love that. Because that's like why I like self-directing, is because you're more connected to your money. Yep. It's so, to me, unsatisfying to just like fill out a form and it just got invested into some mutual fund. I don't even know who's managing it, from where. It's just on some paper and some statements. Zero satisfaction if it does well. Yeah, we have over 200 stakeholders in this project, and we view that as a big strength of us.
Yeah.
We don't say, hey, investors, don't call us, just leave us alone, let us send you your money. We're in the process of rezoning a project out in East Valley that was a hotel that we converted to an apartment. And we have all those investors have signed a petition for the city to rezone it. So we view that as a strength, that we have all these stakeholders. We have investors who drive by the properties and say, hey, I noticed there was, some... the weeds need to be pulled. Oh, great. We love that. Yeah. We're not... they
got an eye on it.
They got an eye on it, and
there's some suspicious people out there. They're gonna go talk to them. Be like, hey, I own this property.
Yeah, and we do say don't bother the residents, but feel free to drive by it. Yeah. We one time when we're picking the color of the tile for renovation, we put a post out there and says, hey, which one do you like? Yeah. And our investors can be involved in that because we want to pull that information. We want to crowdsource the best information, and we've got a lot of benefits from that.
Yeah, that's cool. Okay, I was going to grab last question here. Sorry, give me 1 second. Okay, this is a good one. I've had this question quite a bit, actually. This is from Steve. He asks, my retirement account is down 20 to 30%. I was considering rolling over my 401k to a self-directed IRA. What are your thoughts on this strategy? I plan to invest my self-directed IRA into some syndication multifamily deals. Okay, I'll take a stab at this and I'll let you do cleanup and then we'll say adios. But man, Steve, you are like a lot of people right now. There's a lot of people where you're at where you've been investing in the stock market and your account's down. I mean, there's a lot of companies, so don't feel bad. You got a lot of company with you right now, but they want to do something different. But on the other hand, I don't want to sell when the market's down. We've all been told, sell high. I buy when it's low. I sell when it's high. I don't want to sell low. And I get that. I think people are worried about that, and that then it's going to rebound and they're going to miss it. But then on the other hand, they don't really like the stuff that they're in already. So am I going to wait it out? And so he's kind of got this decision to make of, do I hold, like your recommendation is, the analyst here, or do I sell? Now he's thinking about doing multifamily. So my thought would be I don't know, Steve. I don't know. There's two ways to look at it. There really is. We don't know where the stock market's going to go. So let's talk about what we don't know. Eventually it's going to go up. But when? We don't know. Real estate, is kind of like, it hasn't gone down in value, at least not here. I mean, there's some softening in some places, but...
Well, and historically, the great financial crisis was really the only time real estate has gone down since the Depression.
You're going to save me on this answer now?
Yeah. So
what do you think? Well, I don't know. It's hard. It's hard. Well, I've had that. I know a lot of people that are wanting to self-direct right now are in Steve's situation of, I really want to buy real estate or invest in a fund or do something besides being 100% invested in the stock market. And the only one thing I've had some clients kind of work their way through is, I'm going to peel off 50 grand, or I'm going to peel off something so I'm at least got some diversification. I may let the rest come back, but let me peel off something so that I'm on track doing this, learning it, going down a different path.
Yeah. Yeah, I think that's good advice. I know there are some friends of mine and investors of mine who do move their money a lot.
Yeah.
And some are more successful than others. So I don't know, Steve, if you've had your money in the market for a long time or if it's been there a short amount of time. I do think, you are better off if your money's there having a long-term view. And I do love the diversification of putting some money in a syndication, in multifamily, in core growth areas, the Sun Belt.
Yeah.
If you do a smiley face across the United States, and not include California, but you start in Arizona.
That's like more of a smirk.
Across, yeah, exactly. Texas, in high growth areas, we have 100,000 people who move to Phoenix Valley every year, and they have to live somewhere. Yeah. So it's a great place to put money, and it's a good diversification.
Mm-hmm. Okay, awesome. Okay, well, thanks so much, Jamison, for joining us. Thanks, everyone, for listening. This was recorded. Just a reminder, you'll get a notification if you registered, and it's going to go up at directedira.com/webinar. We'll also include the slides. We actually had a lot of slides we didn't hit today just because I just got in conversational format with Jamison. I'm sorry. But I was loving the conversation. So hopefully you listened. Hopefully you enjoyed the presentation today, and we'll be back next month with another Directed IRA webinar. If there's topics you're wanting to cover, things you're wanting to hear more about, please let us know. You can email over the team here, hit marketing@directedira.com. We'd love any of that feedback. And until then, stay calm and self-direct on.